Imagine this. You've spent decades working hard, saving, planning, and now, finally, it's here. Your retirement nest egg. It's ready for you to start enjoying. It's exciting, right?
Definitely.
But then comes the big question. Okay, I'm ready to use this money. How is it actually taxed? How do I handle these distributions without any nasty surprises? Well, that's exactly what we're diving into today. Taxes on distributions from qualified pension plans. This is really crucial stuff if you're nearing retirement, maybe studying for exams like the CPA or EA, or honestly, just if you want to be smart about your own money. Our mission to break down the complexities, different plans, how taxes are calculated, what happens if you wait too long, the whole picture. Before we dive deeper, a quick reminder that this deep dive is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, so let's get started. When we say qualified pension plan, what exactly does that umbrella term cover? It sounds like one thing, but the source material really splits it into two main types.
That's right. We're mainly talking about defined benefit plans and defined contribution plans. Let's start with defined benefit. Think of the traditional company pension. You know exactly what you're getting. A fixed payment, maybe for life, maybe with inflation adjustments. The key here, the employer takes on the investment risk. They promise you a certain payout.
Okay, so that's the guaranteed income stream. Predictable.
Exactly. Now, contrast that with the defined contribution plan. Think 401k, 403bs. Here, the payout isn't fixed. It depends entirely on how the investments in your account perform, stocks, bonds, whatever's in there. So the risk and the potential reward, that sits more with you, the employee.
Got it. Defined benefit, employer risk, fixed payout. Defined contribution, employee risk, variable payout. That distinction is huge. And this leads to something interesting, a strategy people use with those defined contribution plans, right? Cashing out by an annuity.
Yes, precisely. It's a common move, especially as people get closer to or enter retirement. See, an annuity provides a fixed payment, maybe for life, maybe for 25, 30 years. So by taking that fluctuating balance from a defined contribution plan and buying an annuity, you're essentially trying to create your own defined benefit plan.
So you're locking in a predictable income, reducing that market risk.
Exactly. It's about peace of mind for many people, taking market volatility off the table in retirement.
Okay, so whether the money's coming from that pension, a 401k, an IRA, the million-dollar question remains, how does the IRS view these distributions? Is it all taxable income?
Well, this is where it gets, let's say, nuanced. Think of it like the weather forecast. Sometimes it's all taxable, sometimes none of it is, and often it's a mix. The fundamental rule comes down to, did you already pay tax on the money you put in? If your contributions were pre-tax, meaning you got a deduction for them or they weren't included in your income back then yes, everything you take out is taxable.
Okay, that makes sense. Defer the tax, then pay it now.
Right. But, and this is the important part, if you made after-tax contributions, sometimes called non-deductible contributions, well, you already paid income tax on that money. The IRS isn't going to tax you twice. So that portion comes back to you tax-free. Understanding that difference is absolutely key.
And that brings us neatly to the simplified method. This sounds like the tool you need, especially for annuities, to make sure you're only paying tax on what you actually should be paying tax on, getting that after-tax money back without another tax hit.
That's exactly what it's for.
Yeah.
The simplified method helps you calculate the part of your annuity payment that's just a return of your own previously taxed money, your return of principal, or return of capital, as it's sometimes called. The calculation itself is, well, fairly straightforward. You take your total after-tax contributions, the amount you already paid tax on, and divide it by a number representing the expected future payments.
And where does that number come from?
It comes from IRS life expectancy tables. They have tables based on your age when the payments start, or the combined ages if it's a joint annuity, like for you and a spouse.
Okay, let's walk through an example. The source mentions Tom. He gets $2,000 a month from his company's plan. Crucially, he contributed $97,500 over the years using after-tax dollars. He retired at 64.
Right, so we look at the IRS table for a single life starting payments between ages 61 and 65. The source says that gives us an expected payment period of 260 months.
So the calculation is $97,500 divided by 260.
Exactly. $97,500 divided by 260 equals 375. That $375 is the portion of his $2,000 monthly payment that is not taxed. It's simply Tom getting his own already taxed money back.
Okay, so the taxable amount is the rest. $2,000 minus that $375.
Correct. $1,625 per month is taxable as ordinary income. The key takeaway is that $375 is tax-free because you already pay tax on that principal amount. A lot of people miss this and end up overpaying taxes.
That's a significant difference each month. And I assume there are slight variations, like if Tom included his wife.
Yes, absolutely. If, say, Tom took a slightly lower payment, maybe $1,800, to cover both himself and his 62-year-old spouse, their combined age would put them in a different IRS table, likely with a longer expected payout period, maybe 310 months in the source's example. That would change the calculation. His $97,500 divided by 310 would mean about $314.52 is tax-free each month. Same principle, just different numbers based on life expectancy.
And if payments aren't monthly, like quarterly?
You just adjust the denominator. If the table gives you, say, 360 months, 30 years, and you get paid quarterly, you'd use 120 quarters, 30 years, 4 quarters, in your calculation.
So the bottom line here is knowing about and correctly using this simplified method for your after-tax contributions can genuinely save you money throughout your retirement. Don't pay tax twice. All right, let's switch gears a bit. Required minimum distributions, RMDs. This is something folks often put off thinking about, but they're incredibly important, aren't they? Why do they even exist?
They exist because the government, while generous in letting your retirement savings grow tax-deferred for decades, eventually wants its cut. They won't let you defer taxes forever. RMDs are the mechanism forcing that money out so it can finally be taxed. It ensures that the tax deferral isn't permanent.
And that penalty for not taking it, it's steep. 50%.
Yes, a 50% penalty on the amount you should have taken out but didn't. It's huge. It really underscores how serious the IRS is about this.
Yeah.
It's basically saying, we let you defer, now it's time to pay up, and don't ignore us.
Wow. Okay, so how do you avoid that massive hit? Who figures out the RMD amount?
Well, for qualified plans like 401k, usually the plan administrator helps calculate and sometimes even distributes it. But for IRAs, it's on you. The taxpayer is responsible.
That's a critical difference. More room for error with IRAs if you're not paying attention.
Definitely. And it's worth noting, Roth IRAs are different. Since the contributions were after tax, there are no RMDs for the original owner during their lifetime. The government already got its tax.
And the age for starting RMDs has changed recently, right?
Yes, it has. You used to be tied to age 70 and a half. You generally had to start taking RMDs by April 1st of the year after you turned 70 and a half. But legislation changed things. For anyone hitting that age milestone after January 1st, 2020, the starting age is now 72.
Why the change?
The reasoning often cited is that people are living and working longer. It gives folks a bit more time before they have to start drawing down those accounts. Maybe a little nudge from certain influential people too, perhaps.
Okay, so age 72 is the new trigger, generally. How do you actually calculate the RMD amount once you hit that age? Is there a formula?
Yes, there is. You take your account balance as of December 31st of the previous year, and you divide it by a number called the minimum distribution period, or MDP.
Another factor from an IRS table.
Exactly. The MDP comes from IRS life expectancy tables, like the Uniform Lifetime Table in Publication 590B. Your financial institution often calculates this for you, especially for IRAs, but it's good to know how it works.
Let's use an example again. Say we have Joseph. He's unmarried, turned 76 in 2020. His IRA balance at the end of 2019 was $110,000.
Okay. We'd look up age 76 in the Uniform Lifetime Table. Let's say the table gives an MDP of 22 years.
So his R&D for 2020 is $110,000 divided by 22.
Precisely. That comes out to $5,000.
Right.
That's the minimum amount Joseph must withdraw from his IRA during 2020 to avoid that 50% penalty.
And what about someone who fell under the old 70 and a half rule?
Good question. Say Joseph turned 70 on March 1st, 2019. He hit 70 and a half on September 1st, 2019 before the rule change. His RMD clock started then. Let's say his balance at the end of 2018 was $300,000. The factor for age 70 might have been 27.4.
So $300,000 divided by 27.4
is about $10,949. That would have been his RMD for 2019, and he'd have needed to take it out by April 1st, 2020.
It seems pretty straightforward once you have the balance and the right factor from the table.
It generally is. There are also specific rules for beneficiaries who inherit these accounts. A spouse often has more options, like rolling it into their own IRA. A non-spouse beneficiary usually has to start taking RMDs based on their own life expectancy using a different IRS table, and that factor typically reduces by 1 each year.
So careful planning needed there too, especially for beneficiaries. It's clear the system is designed to eventually get that tax revenue. Okay, let's talk about accessing the money before retirement age. The general rule is a 10% penalty if you take money out before age 59 and a half, right? But there are exceptions.
Yes, thankfully. The IRS understands that life throws curveballs.
Yeah.
So while that 10% early withdrawal penalty is the default, there are several important situations where it's waived.
Like what?
Well, for starters, if the distribution happens after the account owner has died, the beneficiary doesn't pay the 10% penalty, regardless of their age. Permanent disability is another major exception.
What about medical costs?
Yes, if you have really high unreimbursed medical expenses specifically, amounts that exceed 10% of your adjusted gross income, or AGI, you can take money out penalty-free to cover those costs. There are others too, like using funds to pay health insurance premiums if you're unemployed, or for qualified higher education
Is
expenses,
that from any account?
usually from IRAs for education.
Yeah.
And there's also a popular one for first-time home buyers. You can take out up to $10,000 penalty-free from an IRA for a down payment. It's a lifetime limit, though.
That's quite a list of exceptions. It shows some flexibility. And we saw a big temporary one recently with the CARES Act, didn't we?
We did indeed. That was a major one in 2020 due to the pandemic. It allowed people affected by COVID-19 to withdraw up to $100,000 from their retirement plans without the 10% penalty.
Who qualified for that?
You needed to meet certain criteria, like you, your spouse, or a dependent being diagnosed with COVID, or experiencing adverse financial consequences like losing your job, reduced hours, or business closures because of the pandemic. And a really helpful feature of that CARES Act withdrawal was the tax treatment. You didn't have to pay all the income tax in 1 year.
Oh, right. You could spread it out.
Yes, you could elect to spread the taxable income over 3 years. So if you took out $90,000, you could report $30,000 of income in 2020, $30,000 in 2021, and $30,000 in 2022. That really helps soften the tax blow during a tough time.
That makes sense. It shows the government using these rules to provide relief during crises. We saw something similar with RMD waivers during the 2008 financial crisis too, right? To stop people from selling low.
Exactly. These exceptions aren't just random loopholes. They often reflect attempts to provide needed flexibility when unexpected life events or major economic downturns happen. So, pulling it all together, understanding your plan type, defined benefit versus defined contribution is step one. Then, knowing the difference between pre-tax and after-tax contributions is crucial for calculating your tax bill. Navigating RMDs, know the age triggers, and how to calculate them is vital to avoid that huge penalty. And finally, being aware of those exceptions to the 10% early withdrawal penalty can be a lifesaver if you need funds unexpectedly. It's all about managing your retirement savings smartly.
Absolutely. The goal here really is just to arm you with this knowledge. Whether you're planning years ahead or already retired, or maybe you advise others, understanding these rules makes a huge difference. It helps you keep more of your hard-earned money and avoid costly errors. And maybe a final thought to leave you with. Considering all these rules, the complexities, and the government's clear intent to eventually tax these funds, how does this knowledge change how you think about your long-term strategy? How do you balance that wonderful benefit of tax deferral against the reality of RMDs down the road, or thinking about what your beneficiaries might face? It's definitely a balancing act, but one you're now better equipped to handle.